Hello and welcome to episode 2 of the Capital Markets Exchange podcast. I'm your host, David McClelland, and in this mini-series of podcasts and ahead of the inaugural in-person Capital Markets Exchange event in London on June 27th, 2024, we're taking a closer look at some of the topics that matter most to the capital markets and finance hive communities. Topics such as how artificial intelligence can give traders the edge on the trading desk. That's what we discussed last time out. Find that wherever you find your podcasts. And also understanding the best skill set, culture, and leadership strategies to build a winning desk. That is in our next episode. But today, we're looking at the transition to T+1 settlement and asking, with the end of May just around the corner, are we ready? The transition to T+1 settlement in trading is a critical endeavour driven by regulatory mandates and the need for improved operational efficiency. Shortening settlement cycles not only ensures compliance with regulatory requirements, but also demands streamlined processes and enhanced technology adoption to manage trade settlement, clearing, and funding effectively. This transition poses significant challenges, particularly in addressing operational risks and managing counterparty and market risks associated with FX transactions and liquidity management. However, firms that successfully navigate these challenges stand to gain competitive advantages by optimizing operational efficiency, reducing costs, and fostering market stability. So joining me to talk about the challenges, the risks, the opportunities, and, well, their readiness are senior trader Baillie Gifford, Stephanie Fraser, head of trading at Evenlode Asset Management, Callum McPherson, EMEA head of capital markets, ETFs, and index strategies at Invesco, Jim Goldie, and director of market practice and regulatory policy at the ICMA, Alex Westphal. Hello, everyone. Thank you for joining us. So, with mere weeks to go to the end of May, how has the industry been facing up to this T+1 deadline? Well, let's hear from our guests today. Stephanie, T+1 settlement, it's a big move for Baillie Gifford. And speaking of settlement, it's been a big move for you too. Tell us a bit more about that.
It has indeed. So, yes, so I'll just tell you quickly about Baillie Gifford. So we are a long-only asset manager. We're based in Edinburgh with a global client base. So T+1 was a huge area of concern for us when we found out about it about 2 years ago. So I've actually relocated from Edinburgh to New York back in January in preparation for the move. So that was myself, another trader, and someone from our operations team.
T+1, if we have, obviously it's North America, so US, Mexico, some people forget that, as well as Canada, all in that final week of May. Why was that important for you for Baillie Gifford to move you and to set up an office stateside?
Yeah, so one of the biggest concerns is just that cross-border trading, so across different settlement jurisdictions. So given that we trade such a large amount of US equities, moving from T+2 to T+1, there's a misconception sometimes that that's going to reduce in the time that we have by 50%, but it's actually more like 80%. So basically what we have to do now in a T+1 world, when we're trading our US equities, the fills come back in at 4 o'clock, okay, on a US time. We've then got to get that trade matched. We've got to get it affirmed. We've got to create the FX and we've got to trade the FX so that the cash is in place for the following day. So it's massively shortened that time that we've got to do that. So for us, we actively negotiate our FX. It's something that we think is really beneficial for the clients because it enables us to get the best possible execution. So had we done nothing, it would have meant that on T+1, we would have had to settle our FX outside of CLS. So that's something else that we can dig into in a bit. But CLS massively reduces the risk, settlement risk, and it also allows you to net your FX. So it's there's huge benefits basically to being able to do your FX within CLS. Now, CLS, there are cut-off times, which at the moment are 6 o'clock US time, so 6 o'clock Eastern time, on trade date. So had we waited to do our FX on T+1, we would have had to do everything bilaterally and we would have missed our CLS cut-off times. So that was one of our top priorities. And we knew that we didn't have at that point, as much as we've got an office out in New York, we didn't have an operations team and we didn't have a trading team.
Big move, but I hope it's been going well for you so far. And a few weeks now until the big T+1 day. We'll pull away at some of the things you mentioned there in a moment. But next, let's come and say hello to Callum. You're not moving to the US. You get to stay in Chipping Norton in rural Oxfordshire, but you are in charge of Evenlode's T+1 efforts. What can you tell us about how you've been taking the lead there, Callum?
Yes, so we're fortunate that our equities trades don't have a direct FX component linked to every single trade. Our custodians in the UK do an FX sweep for us to make sure that we have no overdrafts and enough US dollars to fund overseas trades. And then on our Irish funds, we use their forecasting tool to instruct FX. We know that having your custodian do your FX for you isn't always ideal, given the margins they can charge and the complexity involved in building a TCA tool to benchmark them. But given our scale and our resources, we deem it to be sort of appropriate for our investors. There's only 38 people here in the barn. We're only managing 5 billion. So a very different scale to Baillie Gifford and Invesco. What we have been doing for T+1 is identifying the biggest operational headaches. So for us, it was affirming and allocating the trades. At the moment, that's a manual process at the end of each trade. So we explored moving from fix 4.2 to 4.4 because you can use one of the fields in fix 4.4 to send your broker's allocation. But our provider said, no, we're not moving at the moment. We don't have any plans. So the second route we're exploring going down is deploying a CTM and instructing via Swift.
Okay. And yes, you just gave a bit of an insight there into Evenlode and about its scale. Just fill in the gaps there. It's very much on the boutique side, isn't it?
Yes, yeah, we're a long-only fundamental research-focused boutique. We've got 3 strategies: UK income, global income, and global growth. Company's 15 years old. Yes.
Yeah, and in the beautiful Oxfordshire countryside as well. Good stuff. Callum, we'll come back to some of that in a moment. I want to come on to you now, Jim. Your focus at Invesco is ETFs. How have you been collaborating with your internal teams there and indeed with your peers elsewhere in the industry to make sure this T+1 settlements transition is as smooth as it can be for you?
Yeah, I mean, I think from an ETF perspective, there's obviously a lot of work that needs to be done to manage the transition. I think the beauty of ETFs is that you have a little more flexibility in terms of how you run the funds from a creation redemption from a primary market perspective relative to traditional mutual funds. So for us, as a large asset manager, we manage about $1.5 trillion, fourth largest ETF provider globally with about 600 billion in ETF AUM. We are fortunate in one regard that we have presence across the globe. We have global operating capabilities. We work with large global custodians. So from a resourcing perspective, the resources are there. We are spending a lot of time over the last year or so just refining that operating model to make sure that we can meet the kind of the stricter timeframes that we're going to have to meet when the US moves to T+1. For those that have been around in the industry for a while, like myself, with almost 20 years of experience, our T+3 to T+2 was a big move some years ago, but I think for T+2 to T+1 is a whole other ballgame, and it requires a lot more heavy lifting to make sure that you can turn things around so quickly. We spent a lot of time internally discussing with our operating teams, trading team, portfolio managers, as well as with our industry peers, trying to understand what is the best model for ETFs going forward. How can we manage it as efficiently as possible and make sure that the impact is as little as possible for the end clients, the end investors.
Okay, we'll come back to some of that heavy lifting you mentioned in a few moments' time, but I want to say hi to Alex as well. So you're looking at T+1 from the perspective of an industry association really supporting its members all around the world. What's your assessment on the preparedness of the industry for this upcoming change?
Hi, David. Yes, indeed. No, my perspective is slightly different, coming at this more from a regulatory perspective. And I should perhaps say up front for those few listeners who don't know ICMA, so we're an international trade association representing the international fixed income market. So we're really looking at this from a fixed income perspective. Me personally, I'm coordinating our repo and collateral work, which is obviously a big theme in here as well. And also to say that we're mainly looking at this from a European perspective. So at least I have a little bit less headache in terms of preparing for US T+1, which seems a lot of work. That said, on our side, clearly as well, there's been a lot of discussion on T+1 in Europe as well. So clearly this is taking up way more of my time than it should, or than what I would have ever expected.
And I definitely want to come on to what is next and what the international impact is and what that might mean for Europe and the UK later on. But thank you very much for now, Alex. So let's pull at some of those threads right now. And perhaps preparedness is a good one to tug on next. A headache, you said, Alex. Stephanie, as you said, your operational setup involves a US-based team now, of which you are part, alongside relocating and hiring personnel, I think you've done over there as well. What else have you been putting in place? Apart from the people, what have you been putting in place to make sure that Baillie Gifford is ready for it to be, or hopefully not to be, too much of a headache?
Sure. So on the operational side, I think I said that we've been here since January, so it's meant that we've had a really good few months trying to iron out just even the speed of things. So obviously we've not had operations before over here, so booking out trades, for example, we could see that there was a bit of a lag, especially on a really active day. We start booking out these trades, our equity trades, at 4 o'clock, and we're trying to get these all booked out, matched up in that short time frame to then create the FX. So there was a bit of a lag there. So we've had to do some kind of internal work there to try and iron that out. And we're also looking at the rollover. So if we trade after 5 o'clock US time, that's the following trade date, and we've had to do a lot of impact assessments as to what that looks like downstream. So that's kind of what we're working on at the moment. Also just trying to make new contacts out here. So our settlements team, they need operational contacts out in the US now. So we've spent the last 2 or 3 months building up contacts there. So if a trade isn't matching up, they've got someone to speak to. And then on the trading side, we've been building relationships with our liquidity providers out here. So we did an assessment of our spot FX panel, and we just wanted to make sure that was as broad as it could be, to make sure that we're getting as much liquidity as we can. So there's a kind of like dead zone between 4 and 5, I'd say, in the FX market, when liquidity really does drop. And so we've been trying to see what that looks like. And thankfully, it actually looks it looks okay. It's what happens when we want to trade after 5 o'clock, when there's literally no liquidity there at all at the moment. So these are conversations that we're having ongoing with our custodian banks and with our third-party banks. So that's what we've been busy doing for the last few months, and thankfully feeling in a fairly good place.
Good, pleased to hear it. Jim, you mentioned in your setup really about the scale at which Invesco operates with bureau all around the world, one way or another. Stephanie spoke a lot about the importance of timing here on a T+1 model. Is that a similar experience to how you see things playing out? And what have you got in place to try and make sure you can be as operationally efficient as possible within that?
Yeah, I mean, it's dead right. The timing is key here. I think from our perspective, we've been fortunate enough that we haven't actually had to kind of move a lot of resource around as a firm. We already had procedures in place where we could kick stuff off on T with our US teams, whether that be in-house at Invesco or with our custodians, where they can do some of the post-US close tasks, hand it over to our operating teams in Dublin, who can pick it up in the European morning, and then kind of finish off whatever tasks that need to go out in the morning. So our brokers, our market participants, exchanges, clients, all have the information that they need prior to the start of the trading day in Europe. And then likewise, we can pick up stuff in the morning on behalf of the US ETF range as well and pass it back to the US guys when they're in the office. So we haven't had to staff up in the US, for example, I know a lot of firms have had to do. We've just had to refine that model because the timelines are being more constrained, just to make sure that process is more seamless, see where we can automate functions or just meet more condensed timelines to get things out to market maybe a little bit quicker than what we have been doing. Obviously, for a large asset manager, we do a lot of trading. There's a lot of scale there, so we need to make sure that process is as seamless as possible, reduce the amount of manual input, and things like that. So there's been a lot of engagement with our internal operating teams, but also with our global custodians as well. And I think communication is key here as well when it comes to the trading community, the brokers, the clients. Just make sure that they have the information that they need to understand what will be changing from the way that we manage our funds or the way that our funds trade, whether it be in the primary market or the secondary market. Because what this does create is that when the US, Mexico, Canada, India as well on T+1, it creates that misalignment where the standard settlement cycle in Europe will remain T+2. So when you're trading at ETFs in Europe, European clients will still have T+2 as their standard settlement cycle. However, when we are trading the baskets of bonds or stocks, they're set on T+1. So we have to adapt the model to meet those requirements, which then does have some sort of knock-on effect to the end investor. So it's just to make sure that the brokers are aware, they know what we are changing, they know how that's going to impact them, and then they can interact with clients accordingly.
And what's been the messaging back to brokers, to clients with regards to the upcoming change? Have you had to play an explanatory role, a reassurance role? Do you find as though the level of knowledge among your clients is already fairly high?
Yeah, so I would say both it's explanatory and reassurance. I think that with a market structure change like this, it's huge. I think we can't underestimate it. It's the reason that we're having a podcast like this. It's one of those things that it impacts everything, whether it be ETFs, mutual funds, stocks, bonds, FX, sec lending, corporate actions. It really does impact the entire market. So I think I feel like for a large market structure change like this, there has been a lot of engagement, there has been a lot of involvement, whether it be from brokers, from clients, with regulators. I think the industry has been engaging pretty well on this topic, but there is just a lot to unpack. There is a lot that we need to do, and I think we need to make sure that we are communicating that effectively so market participants understand how it will impact them. So when it comes to clients, I think they are wanting to understand what are the changes that we are making and what does that mean from them when they are trading ETFs. And I'm using ETFs, but really I'm meaning UCITS ETFs, European ETFs, which is really a wrapper for ex-US investors. So everywhere from Latin America to APAC and everywhere in between, they are the main users of UCITS ETFs. So some of the changes that we will have to make is that when we manage the fund, when we're out transacting in the US stocks and bonds that are set on T+1, it means that the creation redemption cycle on those impacted funds for primary market transactions will move to T+1. However, clients will still be trading with their broker on a T+2 basis. So there is a funding gap there
Yeah.
that clients will have to be aware of and that brokers will have to manage.
Thank you, Jim. Callum, obviously a different size of operation to Stephanie and to Jim's there, but does this timing factor that both Stephanie and Jim spoken about, does that play into what you do quite so much? Maybe the communication thing's quite different as well.
Yes, yeah. So we have been looking at timing, but more on the subscriptions and redemptions coming into our fund.
Right.
So we were still on T+4, and obviously with the US moving to T+1, that creates quite a large gap there. So we've moved the funds to T+3, which the IA described as a large minority. So I think we were in a large majority. No, we're a small minority still at T+4. I think we were behind the curve there somewhat, and we have discussed moving them to T+2 to reduce that cycle even further. We've also looked at the whole operational workflow, and even in the sleepy countryside, it's obvious that you need to try and remove any manual process anywhere if you can, and that's why we've been looking into the CTM solution from DTC and enabling Swift communication for various messages.
Really good point, and that's where I want to come on to next with regards to technology and automation and the role that third-party suppliers can play into this. And we were speaking on the last podcast about the evolving role that AI has to play on the trading desk. I'm just curious about the role that technology, automation, maybe even AI has to play more specifically where we are with T+1 at the moment. But maybe building up to that has there been an element of manual process review and automation that you've needed to take a look at? And I guess this all kind of fits into the overall operational efficiency improvements that T+1 gives, maybe the kind of unintended benefits of the move, maybe.
Yeah, I mean, it's something that we've had to take a closer look at to make sure we are doing everything we can to make processing trades as seamless as possible. I think for an asset manager of our scale, we've kind of tried to utilize as much technology as possible to make sure that we are removing as much manual input as we can and making processes as scalable as possible. I think given the timeline around the move from T+2 to T+1, I don't think there's been enough time for whole-scale technological changes that the industry's been able to adopt. And I think the traditional financial infrastructure can cope with the move to T+1. Yeah, we need to redeploy capacity or refine processes, but I think that the technology that we've got is enough for us to manage this migration. What I think will be interesting is when the kind of move to T+1 is just one part of that question. The rhetoric from the US is that it's inevitably going to be a step towards T0. Then you need to really think about how do we implement technology? Are we looking at DLT and blockchain technology to be able to facilitate some of these T0 transactions? Because being able to manage a T0 world in traditional financial systems, I just don't see how that would be possible. So I think for now, I think the way that our systems are set up, I think that the way the industry's set up, we have enough technological capabilities to manage it. We just need to refine things a little bit. But I think the next step, if we are looking at a T0 world, that's when we need to seriously have a think about technology and do we need to make some big changes as an industry.
Yeah, and on T0, we've got some questions that have come in from the community that I want to fire your way as maybe part of our crystal ball round later on. Finally, on this one, Alex, with regards to automation, with regards to operational efficiency and processes, what's your take on the adoption of technology to try and, I guess, keep up not only with what T1 mandates, but also with what future T0 will inevitably mean?
No, I mean, this has been a huge focus for us over the years already, completely irrespective of T+1. Now, of course, there's a very significant additional driver, but clearly as part of our discussions, and there, I think in the repo space particularly, there's always been a bit of a concern with remaining manual processes. So there's been a lot of focus on driving automation and efficiency in the post-trade space. We've also had a very big focus over the past months on settlement efficiency, which continues to be an issue. And I think here as well, there are clearly some risks related or a very clear link to T+1 as well. You wouldn't want to implement T+1 in an environment where already there are big problems with settlement efficiency. So there's clearly a lot of pressure now on the industry in order to get our house in order before a move to T+1 is even conceivable without significant risks.
Well, and in terms of those risks, for some T+1 might be a technology challenge, it might be a process challenge, or maybe it's just the challenge that comes with any type of major change. Alex, what do you see as the risks for many of the firms like we have on our panel today, and others that may be listening to this, of not being ready, of execution on the day not being quite right?
Yeah, I mean, clearly settlement efficiency is one. So that's something that you don't want to undermine in the market. And I'm speaking here perhaps even more from an EU perspective, where we've seen more challenges with this even. And of course, there are also the structural differences between the UK and the EU, and we'll come back to the separate discussions in a moment probably. Yeah. But yeah, clearly there are already challenges with settlement efficiency that we don't want to see undermined, and in some way. What is quite interesting, I think, with the discussion on T+1 is that it's there's surprisingly little understanding of the costs and benefits of T+1, and surprisingly little discussion as well. So this is something that we always want to raise to the attention. I mean, obviously the costs will be huge, and we've discussed that across the board. What is a little less clear is what the benefits are, and there has been little quantification of those. In the US, there was a lot of thinking, or a lot of focus on the reduction of risk and margin requirements and related costs, but that might well be quite different in Europe. It's just not something that has been really looked at.
So before we come on to that piece around what's next, what might this mean for UK and Europe, it's like you're reading my conversation notes here, Alex, because the benefits, as you put them, clearly there are some enormous costs here. And Stephanie, you're part of a team that's moved over and set up in the United States. But when you're articulating, or when you and your team are trying to articulate what the benefits of this process are, what do you see as the benefits, not only to you at Baillie Gifford, but also to your clients as well? Do you have a little hit list of, these are the big three benefits as we see them, and we're going to get some return one way or another based on these three?
In all honesty, it's a struggle as a European asset manager to pull out benefits while that misalignment is there. I think Alex used the word headache earlier, and I think we would agree with that. It has been more of a headache, but it is what it is, and that's where we're at. And there's no change in that. So that's why we've had to prepare for it. So I think down the line, when we're aligned and we're all at T+1, I mean, T+0 is just something that I can't even start to think about. I mean, we spoke about, I think you said DLT and blockchain and what have you. I think we definitely have to have all that in place. So that's, I think I'll have retired by the time that happens. So benefits, yes. I mean, obviously it is going to free up, the risk reduction, freeing up cash quicker so that you can put that into use and reinvest, are the benefits that jump out when we all get alignment.
Just to mark your card, I will be forcing the T0 question in a moment's time. But Callum, I saw you give a bit of a wry smile there when I mentioned benefits, and Stephanie echoed what Alex said around headaches. How's your headache going there, or are you able to find some gold at the end of this rainbow, perhaps?
I think in terms of benefits, we'll have to wait and see, to be honest. We saw after the change from T+3 to T+2, we saw increased liquidity, reduced counterparty risk, and a few other things. But whether that will be the case this time, I don't see why it shouldn't be. You do have the headache that we've all mentioned, but hopefully in some number of months' time, we'll see the benefits, and it'll all be worthwhile. There might even be FX liquidity after 5:30. Who knows?
And Stephanie, if there's one thing that you think might help this process move a lot more smoothly, what would that be?
Okay, I've probably mentioned CLS cutoff times already, but I'd say that is our top priority at the moment. So CLS cutoff time is 6 p.m. Eastern time on trade date. Now, a lot of the banks have cutoff times which are quite a lot earlier, let's say, than 6 o'clock. And what would be a huge help is if those banks were able to bring their cutoff time closer to that 6 p.m. So we've been having conversations, and I know that some banks are there. They're able to, they kind of told us 5:15, maybe even up to 5:45. But there are still some outliers which are kind of 3:30. Now, wow. It's so important that we get to as close to 6 p.m. as possible. Being able to do our trades within CLS cuts out so much risk and has so many netting benefits. So yes, that would be my one ask would be for that.
Jim, very quickly, finally, anything to add in terms of the risks or the benefits indeed?
Yeah, I mean, I think we'll touch on the kind of political angle in a minute with Europe and the UK. I think the risk is there that we don't do that or manage that transition in a harmonised manner. If we have divergence between European countries, either whether within the EU or between the UK and the EU, then I think that's where it's going to give us more challenges as an industry. I think in terms of benefits, a lot of people in Europe will kind of agree that the main benefit, some may argue the only benefit of this, is global harmonisation, where we align and we remove the headaches that we've just been speaking about the misalignment, and everyone is harmonized on T+1. Then all these things about funding, liquidity, time zones kind of ebb away because everyone is operating under the same time frame. Yes, you'll still have time zone challenges from the US to APAC, just given the way that the world spins, but it takes away a lot of the pain and operational friction of having the misalignment, which is a big challenge. I think if you look at the driver for the move, though, in the US, it was driven by the meme stock craze with if anyone's seen the film Dumb Money about the GameStop short squeeze, it was things like that really driven the move to T+1 in the US, where you were having such wild stock price changes between the point of trading and the point of settlement over that 2-day period. They were trying to remove that risk from the system, and you can understand why, given the events that happened in the US. In Europe, we haven't really had any market events like that, so there's a lot of people arguing, do we need to do this in Europe? But I think that the benefits of harmonization and removing a lot of the headaches of misalignment is reason enough. And also from a political perspective, European capital markets are being positioned versus US capital markets, and we are being left behind. If you look at trading volumes over the last 10 years, Europe is flat. The US trading volumes are up 25%. We need to see how we can get trading, get people back into Europe as a place to list their stocks, as a place to invest their wealth. And I think that we need to start moving towards having more efficient capital markets like the US has done. It is just a lot more challenging for us to do it.
Okay. Well, let's come on to that then. Of course, T+1 settlement hits US, Canada, Mexico at the end of May. But what impact does that have on Europe and indeed in the UK? Alex, what do we know so far about ESMA and the FCA about their intention to move to T+1? Are they watching to see how it goes in the US, or have they already stuck their colours to the mast?
I mean, that interesting that you asked that, because of course, and that's one of our key points. There's no rush from our perspective, at least, but it's the US has taken the decision. In Europe, it's of course still, as mentioned, still a live discussion with some open questions, and clearly this is also an opportunity for Europe now to learn the lessons from the US move, see how that goes, and also what are in a real life the costs of misalignment, and that will of course allow us to draw some conclusions also in terms of the urgency and the timeline that we need to follow. Now there are separate discussions in the UK and the EU. In the UK, clearly more advanced. So if we start there, there's been an industry task force that was put in place in December last year already. The Accelerated Settlement Task Force were part of that. That was led by an independent chair, Charlie Geffen. It's been a bit of a twofold process. So the first phase of that process was a little bit peculiar, with very much driven by this core group. That led to an interim report that was issued just recently in March, so end of March, with quite an optimistic or quite an ambitious tone on T+1. So the conclusion clearly is, or the message clearly was, the UK should move to T+1, and those recommendations were also adopted by the government. So that's clearly the approach in the UK. There have been, from our perspective at least, some positive developments or some important points to note, perhaps. First of all, in terms of timelines, so what the report now in the end says is that the move should happen by the end of 2027, which probably from a UK perspective is a reasonable timeline. There are some operational challenges or changes that are being recommended as well, related to the timing of matching and confirmations and allocations. Those are a bit more imminent, so those are recommended to go live in 2025 already. So that's something to keep in mind. Important point from our perspective is that the discussion around scope. So initially there was a suggestion to have the scope, to recommend a broad scope for a UK T+1 requirement. That has been narrowed now, so it would only apply to anything traded on a UK trading venue and settled on a UK CSD. It's a bit of an open discussion, but it's a very important point, because it means that basically all the UK corporate bonds wouldn't be captured by that, because they are Eurobonds, so they're settled in the ICSDs, which are in Europe. And that, from our fixed income perspective, is of course quite an important point, because even if the UK moves ahead of the EU, you would still have that alignment on the fixed income side. Now on the EU side, the discussion is clearly a little different. ESMA, the regulator, has a mandate to work on a cost-benefit analysis in relation to T+1 by the end of this year. And there was a consultation that finished in December. We responded to that. That was really very much a call for evidence. So they wanted to see some real data and figures and cost estimates. But as I already alluded to, I mean, there's relatively little, and we also struggled a lot to put something together. So I think they were a bit disappointed with that. But they are on the back of that consultation. They're now working on the final report, which will come out later this year, which will have some recommendations. But that said, just a final point on that as well is that from a political level, there has been quite a clear message from the Commission as part of a roundtable that they hosted in Brussels, that they are clearly expecting the EU to move to T+1 as well, although the timeline is still very much an open question. So it does feel inevitable, but clearly there's still a lot of scope in the political discussions how that will then happen.
David, I was going to jump in and just one of the points, just to expand on something Alex said, just touching on the fixed income side, which we haven't spoke a huge amount about, but ICMA came out with some really helpful guidance 2 or 3 weeks back now, and it was just talking about the difference between excess and US ISIN code. So initially, I had always been thinking that it was all US securities which were captured by this new T+1. But actually, it's just those that settle within DTC. So that's those with a US ISIN code. So this is really helpful for us because, we touched on this earlier, but our OICs, for example, our UK OICs, they settle their standard settlements T+3. I mean, we are reviewing potentially moving that to T+2, but we have a lot of flows in US fixed income, for example, and what we've been working on, so this might help some of the listeners, we've been reviewing where we actually hold our US securities. So, because you can hold them in DTC or you can hold them in Euroclear. So at the point of trade, I don't want my traders having to worry about, okay, is this a Euroclear? Is this a DTC trade? So we're going to have all our excess ISIN codes held within Euroclear, and we're going to have all our US ISIN codes held within DTC, so that there's just, at the time of trade, that's not really something that our traders have to consider. And we know that we can settle T+2 on those excess ISIN codes. And I've also been doing some work just going around all the electronic trading platforms to ask them how they're going to cope with this change. And it sounds like T+2 is going to be the default for excess ISIN codes, which is really helpful. So just something else for the listeners to keep in mind.
Good stuff. And in the interests of time, and speaking of our listeners, the questions that we've had in from the community, I think we actually just answered one of those with the, this was someone from AXA Investment Management talking about, there's a lot of talk of when the UK or Europe will follow. Do you think they should follow suit to T1? Is it a good thing for the industry? Well, we've spoken about, as Alex said, some of the work that's going into asking and hopefully finding some answers, or at least some responses to exactly those questions. So maybe time will tell. But we've got another question. This is somebody from BNP Paribas Asset Management. Thank you for your question. What can you automate in the settlement cycle to make this all easier? Have you increased your use of auto trading on the back of T+1 settlement? Maybe this is aligned with some of the technology and automation questions I was asking earlier on. Anybody have anything to bring to that in terms of auto trading, perhaps?
I mean, I don't think there's going to be anything that's any whole scale changes as a result of T+1. I think obviously the infrastructure will change over time, and we'll try and adapt the most efficient way of trading and settling as we can. We'll see where we can automate processes where we can. But I think that the infrastructure that we have to work with now can manage a move to T+1. We're operating under more confined time frames. So I think things like the trade affirmations, contract notes, I think for us, a lot of that stuff is being automated currently. It's just, can we get the necessary inputs a little bit quicker and get that output out to the market a little bit quicker to meet those more condensed timeframes? And it's that refinement that I can go back to earlier, where we're not having to make whole scale changes here, but we now have to meet new demands of condensed timelines. And to do that, you may just need to refine things a little bit better, or kick off process runs a little bit earlier, that kind of thing. So I don't think there's going to be massive changes to the industry in terms of automation, but I think where we can make things a little bit slicker, I think everyone will be doing their best to make sure that they do that.
Well, the end of May is a very real deadline in terms of time to get T+1 settlement ready. And unfortunately, the clock is down for us today. We are out of time. So for now, thank you very much indeed to Stephanie, Callum, Jim and Alex for joining us. Thank you for sharing your expertise, and good luck with what the coming weeks will bring, everybody. And on the next episode of the CMX podcast, we'll be focusing on the best skill set, culture, and leadership strategies you need to build a winning desk. Make sure you subscribe to get that as soon as it goes live. And if you like what you heard today, then do share it with your trading community. And hey, leave some feedback via the Finance Hive. Also, make sure you are subscribed to the CMX on LinkedIn. And if you haven't already, head to the CMX website. That is the-cmx.com. the-cmx.com, the-cmx.com to find out more about and register for the Capital Markets Exchange event in London on the 27th of June 2024. But for now, from me, David McClelland, and from all of our guests here today, thank you for listening. Until next time, bye-bye.